has been a volatile week for the equity markets. While the positive sentiments prevailed on back of US President declaring that US-China trade deal would be signed on Jan 15th, 2020 and rupees 102 lakh crore of infrastructure push from Indian government over coming 5 years to reach 5 trillion economy, along with positive data on Indian PMI and GST tax collection. Escalation of geopolitical tensions between US and Iran on Friday morning led to weak sentiments. Crude oil prices spiked on expectations of retaliation from Iran. For the third week in a row, RBI is scheduled to conduct special OMO by buying the long-term and selling short-term bonds to ensure the long-term borrowing costs stay low. Rising crude prices had an offset effect on the bond prices after this announcement. For this week, we have identified Hindustan Unilever as our pick of the week. Hindustan Unilever is largest FMCG player in India. Its product portfolio consists of wide spectrum of daily need goods, including home care, personal care, food and refreshments, and water purifiers, etc. In terms of direct distribution, Hindustan Unilever has one of the largest direct distribution networks, that is retail touchpoints, in FMCG sector serviced by over 3,500 distributors. Strong business model and deeply entrenched distribution network enables Hindustan Unilever to manage cyclical downturns better. Given the long-standing history, strong product portfolio, best-in-class margins and reaching 8 million outlets of distribution network allows Hindustan Unilever to manage downturns better than its peers, as has been observed time and again, and in face of critical events like in times of demonetization and implementation of GST. Although its parent Unilever PLC has revised guidance downwards for CY19 and H1 CY20, we believe in Indian context, Hindustan Unilever is better placed to wade through cyclical downturns following its robust processes and balanced strategy of tactically prioritizing top line and bottom line growth by offering most consumer value by keeping a check over costs. GSK Consumer's merger is going to be hugely value accretive for Hindustan Unilever. GSK Consumer's merger with Hindustan Unilever would raise its presence in food, that is malted foods category, and could aid to 5 to 7% accretion in earnings upon successful integration. Besides, the management has indicated that EBITDA margins are likely to add around 1000 bips, that is around 10 percentage points to current 25 percentage points margin profile. Health foods, which is rupees 7,700 crore category in India, has just 14% rural penetration. Hindustan Unilever, with its vast distributor network, which is 3 times the direct distribution reach over GSK Consumers, has huge growth potential in this category. Hindustan Unilever offers relative comfort in earnings growth in listed consumer staple space. Hindustan Unilever has constantly expanded EBITDA margins each year over the last 8 years and has industry-leading return ratios led by its focus on cost efficiency plans and premiumization. It offers most visibility, that is approximately 18% earnings CAGR over FY19 to FY21 in FMCG staples packs, with multiple drivers for growth, namely winning in India, many Indias, that is WIMI strategy, strong execution, thirst on naturals portfolio, focus on premiumization and market development to drive profitability improvement, extensively employing technology and data analytics to remain ahead of competition. We hence recommend a buy on Hindustan Unilever with a target price of Rs 2175. Thank you.